So let's have a look at what is going to be the interest rate forecast in the US. So let's just be clear here that the US, the Fed, the central bank, has indicated recently, as of Friday, the 22nd of August, that the economy looks like it warrants a interest rate cut. Now, we've been saying this non-stop, that rates are going to go down in September. However, recently, due to the statements coming out from the Fed has clearly stated that with a robust employment market or robust workforce, then it's unlikely that they'll be reducing interest rates. In other words, they were quite hawkish when it came to the outlook on interest rate. But suddenly, everything changed. So what changed as far as the Fed is concerned? Well, the Fed, the central bank in the US, is behind the curve. What does that mean? They're always late in the news. They're not really up to date with what's going on. And recent numbers coming out from the Bureau of Labor Statistics, the BLS in Washington, which reports on the non-farm payrolls, which is the employment number in the US, has been readjusting their numbers month on month. In the last couple of months, they readjusted the numbers downwards to around about a loss of 258,000 jobs in the US economy. And that shocked the Fed and also shocked financial markets. Simply put, what the financial markets, the stock markets, traders, investors, analysts understood that was a rising employment actually is falling employment and rising unemployment, and that has prompted the US central bank, the Fed, to issue a statement that will be looking at interest rate cuts throughout the rest of the year, starting with September. Now, we stated clearly on driving markets that interest rates would be cut significantly, starting with a 25 basis point in September, maybe even 50 basis points in September, and then there'd be another one in October, and then in November and in December. Donald Trump, the president of the US, and the Trump administration, what they want rates down dramatically. Now, why do they want rates down dramatically? It's quite simple. They have to borrow a ton of money. They want to borrow billions or refinance all of the trillions of dollars out there at a lower rate. We have to remember that a lot of those bonds are coming to maturity now, and the present interest rate is about 4.5% to 5%. The existing rate on those bonds is anywhere between 0.5% and 1%. So that cheap paying of yields to investors and traders is going to disappear. It's going to be replaced by much higher rates. So what the Trump administration want to do, and Scott Bessent, is to lower interest rates dramatically in order that they can refinance all of the US debt at a lower rate and therefore save the US significant amounts of interest. So that's why they're putting pressure on the Fed to lower interest rates. However, the bond market, which is the main market to look at when looking at financial markets, probably won't have any of it. What they're looking at is saying, hold on, we've got a failing economy and increasing debt. So where is the money going to come from? Where's the revenue going to come from in order to pay this debt? And that is the question mark hanging over the bond market. So what the bond market will likely do is push yields higher, not lower. By pushing yields higher, it means investors and traders will be demanding and getting a higher rate of return on lending the US government money. What's the problem with the US government paying the debt? Well, with lower revenue coming in, they haven't got the wherewithal to pay the interest payments. So what they will probably do is print a load of money. And by printing a load of money, that will cause further devaluation of the US dollar and therefore push yields even higher and push inflation up. Remember, inflation is not 2% or 2.9%. Inflation, real inflation, is the cost of living. What's it costing you in terms of your household? And that floats anywhere between 6 and 12% on a estimate. What does that mean? All depends. If you've got children, you pay insurance, you have a car, 2 cars, you travel, recreational activities, restaurants, all of that will impact your basket of goods. Therefore, real inflation is the cost of living, not what is stated by the Bureau of Statistics or the Bureau of Analytics or Economic Numbers. What is real inflation is what you are paying out of your pocket. So going back to interest rates, yes, will fall, but I don't see that bond traders will drop yields on the bonds, and that could cause a fallout on financial markets short term, as more money is then printed to reflate all of the stocks and shares and crypto, gold and silver. And what will happen is you'll see stock markets eventually go to all-time highs, but near term, short term, you could see a significant pullback on an environment of concern that there could be an economic slowdown, which is forcing the Fed to reduce interest rates accordingly. And that is one of the concerns. So where would you go to in order to protect your dollar or protect your money? You probably go to gold, silver, and maybe even platinum, which is undervalued. So gold and silver will continue moving higher, in my opinion, for social media. And the miners, which is the GDX and the GDXJs, the junior miners, they are already on a breakout and leading gold higher. They're at a discount to the actual price of gold. So I could see gold moving much higher with a further dollar devaluation, and seeing silver, which has pent up demand, moving higher based on a lack of supply and a significant increase in demand. This is Mayor Vilensky with Driving Markets. Catch you later.